Hello, I'm Greg Bennell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, investors are digesting a flurry of earnings. FactSet reports that more than 3/4 of S&P 500 companies that have posted results so far have beat expectations. And with earnings season heating up, Liz Miller from Summit Place Financial joins us just a couple minutes time. I'm going to break down the trends shaping the market from resilient sectors to tech momentum. And then in today's technical take, we're taking a closer look at Microsoft's chart, that ahead of Microsoft's earnings. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour into the trading day, let's get you updated on the markets. The S&P 500 in the pre-market was indicating a bit of downside today, but it has popped into the green. Now that we're actually into the trading day, we're still getting a lot of earnings. Tesla, IBM, we'll take a closer look at Tesla in a moment. We also have a spike in oil prices. The White House putting additional sanctions on Russia's two largest oil companies, so it's lifting some of the oil names on both sides of the border. Let's jump into the heat map, see what's going on. You're seeing some moves higher in tech. They are very modest, but it is enough to have had us flip from that early downside action to the upside. Of course, some names in particular like IBM and Tesla aren't enjoying that. Let's dig a little deeper into Tesla right now. Of course, Tesla, we were just discussing it 2 days ago on TD Active Trader Live with Jason and Hiren doing the bear bull debate. The stock is down today. The EV maker actually reported its third quarter earnings. That looked pretty good, a double-digit revenue increase for the period, but it missed earnings estimates and it saw its capital expenditures move higher as well. So it's got some downward momentum on the name. It was a tough day yesterday for the quantum computing stocks. It's been a bit of a choppy week in a bunch of asset classes, hasn't it? Let's take a look at Rigetti Computing. It is jumping higher today. We got a report out there that the White House now thinking about taking equity stakes in several quantum computing firms. That would include Rigetti in the group, obviously. IonQ, quantum computing, all jumping around 8 or 9% on this unconfirmed report. And that's your market update. Joining me now from London, Ontario is my colleague Hiren Amin from our direct investing education team, and Liz Miller, founder and president of Summit Place Financial Advisors, joining us from New Jersey. Thanks so much for joining us on the program this morning. We're going to have a great show. Before we jump into it, just remind our viewers that the views and forecasts expressed are solely those of Liz and her team at Summit Place Financial and based on their research. Okay, Liz, we're well into earnings season right now. What are your biggest takeaways from what you're seeing?
I think the biggest takeaway is the surprising strength. Lots of reasons over the summer to worry about third quarter. Felt like from the sentiment readings that there wasn't a lot of activity. And now as we've seen a couple sectors report, starting with the financials, moving into some of the staples, we're finding out it was indeed a pretty good quarter. Probably will flow through to that GDP number for the quarter as well.
Pretty good quarter. But the valuations, from what you're seeing in the earnings so far, are they justified given what we're seeing?
We certainly have come into this earnings season with a market overall priced to perfection. So it's really hard to answer the question, are we justifying anything? We certainly knew, and we're seeing in some of these names, any stumble was really going to take a big hit in the market. I don't know what earnings numbers justify some of these valuations right now, but I will say when we do some analysis, you see it's really, when we look at the S&P 500, it's those top 10 names. We know them, the Mag 7 Plus, those driving the tech trend that have very high valuations. And when you look at the 490 below that, we see PEs that are really in line with history. They're a little elevated, but they're not at these really high levels that we think about when we just get that, oh, the S&P is trading at. So we do, even within the market, have a huge bifurcation. Those other 490 names, good earnings are all it's going to take to support the valuations they currently have. And we're all trying to decide what do those business trends look like into fourth quarter and next year.
Liz, that gets me thinking about market rotation. The criticism of the market for a long time was how much was concentrated on just on those big tech names. They dominate all the time. Are we starting to see that rotation?
We certainly are. Certainly here in October, we're two-thirds, three-quarters the way through the month, and we're seeing healthcare, utilities, staples really be the standout sector so far this month, which is good to see because, yes, the first half of the year, they really weren't participating. The rally into late spring did not include them. And in some ways, that made sense. They aren't the high growth companies, but still, we're going to look back and say 2025 was a pretty good year for these companies, most of them meeting targets, having steady growth in a year where we weren't sure what the economy was going to look like.
Okay, I think we might be having a problem with. Is Hiren's mic there now, or is Hiren?
Yeah,
are they
it
can hear
is
each
there
other?
now. So my
as long as you guys can
apologies.
hear each other.
So let's talk about the tech theme, Liz. Of course, we'll still harp on that. When you think about your portfolio positions, is this an area where you're looking to start trimming your positions, or does the retail mantra of buying the dip still hold true where you still want to maintain exposure there?
So we have been trimming positions really throughout the summer. After the big rally coming out of the spring, we do have good exposure. We have exposure to most of those big names. We've had them for years. They're not new purchases, and we're very happy with that exposure. But of course, with the kind of rally we had off of the low in April, these have become very oversized positions for our clients. And so really what we're doing is trimming away that excess risk. Do we think all of these names might have some downside? I don't think there's anyone who sounds surprising to say, oh, of course we could get a 10 to 20% correction. We could, but I'm not smart enough to know what kicks that off. I do recall the dot-com trend, and what's similar here is that we know we are looking at a change in technology that's going to be pervasive, in which we all are going to be doing things differently down the road. What we don't know is is it 3 months? Is it 3 years? And what does that look like? And so it's very hard to value that. But the other really big difference is in the dot-com bubble, we were looking at companies that just had revenues. We were making up new ways as analysts to value those companies. And so when they stumbled, there was nothing to support them. It's a really interesting trend this time when we look at our biggest players here. You look at NVIDIA, Amazon, Microsoft, even AMD, really as leaders in this evolution. And these are solid companies that have been around for many years, proving through every cycle that they could be innovative. And if the AI trend slows or isn't as explosive as we think right now, they certainly have underlying businesses that are profitable. We just don't know how to separate what the right valuation is for both parts today.
Yeah. So let's talk about the AI theme a little bit more then. It's obviously you'd be living under a rock if you didn't realize that it's shaping up the tech sector, of course, and the broader economy. So tell me about some of the risks or opportunities that our investors or retail investors should be aware of.
Well, one opportunity I get excited by, I don't think you hear a lot of people talking about, is the healthcare sector, particularly the healthcare equipment. We own GE Healthcare that spun off. I know we don't talk specific stocks. I'm just giving some ideas of those kinds because you really can imagine the breadth of information from experts across this country being built into the equipment going forward. So instead of wondering, do you really have the best tech there? Do you really have a top physician reading your scans? We're going to be able to build this into the equipment. And I think it's going to give incredible confidence to patients across the country and the world. And I think it's going to be a game changer. And that's a sector we're not really thinking about and talking too much about.
Interesting moves there, and obviously, so we've broken down the markets nicely. Some interesting pockets you're seeing in terms of sectors. Of course, then the Fed's going to show up next week, suck all the oxygen out of the room, take all of the headlines. What are you expecting from the Fed, not only next week, but after that, going forward too?
We certainly aren't going to be surprised. Next week, the Fed is going to lower by 25 basis points. Don't expect any surprises. Will be interesting to see if they change a word or two in the statement. Right at the market open today, we kind of saw those risks there. The spike in oil prices, pulling up down bonds, and this fear that, okay, that could fuel inflation, and what will that do to our Fed? Our Fed has been so focused on inflation well beyond the time frame that other central banks around the world have been, that I'm in the camp that think they've really been late to this game of lowering interest rates. We all know we have two more going forward. I think the real question is, will they start talking about the future? I don't think it's about where interest rates end 2026, 2025. It's much more about, can we talk about 2026? Can we talk about the economic trends we're seeing and how the Fed is going to support the economy into 2026?
All right, Liz, and let's talk about the other theme of the year, which is, of course, gold. Is it losing a little bit of its Midas touch? I know the Indians just celebrated Diwali, which is like a big time to shore up some of the yellow metal. So how are you interpreting this recent pullback that we've had? Is it just a healthy correction that we had? And what does gold's performance clue us about the broader physical stability?
Yes, I think this is just a little bit of profit taking. It does certainly reflect some slight changing economic and political environment around the world. But really, the rally in gold this year is a surprise, and the other precious metals, right? There isn't really a trend that makes it obvious what's going on. So we need to pull that back and look at, where is that demand coming from? It didn't surge this year because it's a hedge to inflation. What it surged because of is, you see central banks around the world now buying more metals, particularly gold, other precious metals, instead of the dollar. So to me, what the message really there is it's a bit of a rebuke of our finances as a country. It's sort of saying, yes, when the world blows up, we do know the dollar is the most stable currency out there, but we want to hedge that a little bit. We want to be putting our money both into US dollars and into gold, a store of value that doesn't take on the debt and the issues that you might be having now or in the future. For us, it's an interesting environment when just recently a Microsoft corporate bond was trading at a negative spread to our U.S. Treasury, really saying that's a better credit quality than our government. And so it is a little bit of a rebuke.
I think when you talk about that rebuke, Liz, and some of the profound changes we've seen in policy in the United States, obviously tariffs are front and center in all of that. How significant of a risk is that for the U.S. economy? I think so far, and being Canadians, we've worried about what it means for our economy. Probably Europe's worried about what it means for their economy. At some point, does it have an impact on the U.S. economy?
The take on tariffs becomes nuanced. So step one is, tariffs don't necessarily drive inflation and economic problems. A tariff gets put in place, it's a one-time step up in prices, inflation steps up, but it doesn't start a spiral or a trend. Companies raise prices, companies take a little less on the bottom line, and then growth goes forward from there. So that's your steady state of tariffs. And since tariffs so far this year have sort of gone in piecemeal on a slow trend, that's been able to be absorbed pretty well by the United States. But here is the risk that we see, because when we raise tariffs here, it does put pressure on our trading partners. And the pressure for them is that we might not be buying as much, that those imports add an extra expense. And so those countries are not seeing quite the same demand. They have higher production costs. And if they have a country that's struggling, like Europe right now, Germany, where there has been, almost flat growth, are we squeezing these countries further? When we look to China, and we're still negotiating there, it really does become key, because China has an internal oversupply. They really do need the rest of the world to be buying from them to shore up their demand. Think of them as the biggest Walmart out there, and there's too much on the shelves, and they're still filling the shelves. So they've got to solve an internal problem as well. So as we are playing this dance of tariffs with them, if the outcome slows their economy even more, that really does flow through the world economy and stresses Canada and Europe even more from our tariffs.
All right. And on that note, Liz, we talked just a moment ago about healthcare. You looked and you talked about how that's possibly an overlooked sector. Is there other sectors that you see opportunities that may have some upside potential? Are there particular names that you're looking at as well?
We've been looking more and more and starting to nibble, as we say, starting to build positions in the home building sector. Now, this is a little controversial, but we really do believe as rates come down, there are some magic mortgage rates in the United States historically, around 5% really kind of turns that spigot on. We know in the US we are really underbuilt for homes, and there is pent up demand. These stocks are trading at much more reasonable valuations, not much expectations there. They're certainly off their lows, but we see real potential there for the future. And we think it's a great play on rates coming down even more and some huge demand going forward.
Liz, before we let you go, we've had a nice wide-ranging conversation. Of course, one of the backdrops for an investor when they're trying to figure out a strategy is where are we in the economic cycle? Do we know where we are in the economic cycle?
Certainly, some great economists out there have good analysis on this. From my take, it's one of two things: the kind of earnings that are coming through in third quarter and what we thought was happening over the summer feels a lot like late cycle. And if we are in late cycle, that sort of means we could see a slowdown Q1 2026 before we start seeing the pickup into the next cycle. But there are those who say that slowdown really was the spring, and what we're seeing now is the pickup of this cycle. We really don't have those traditional full-on recession cycles that we used to have really in the 80s and 90s, where every 3 to 5 years you really called a recession. We've been going, 10, 15 years with sort of steady growth interrupted by true disruptions like the pandemic. So what we tend to see are these earnings and growth slowdowns and then pickups again without really tipping into a true recession. So right now we are either in the later stage of some growth or we are in the early stage of the next wave of growth.
Liz, it was great catching up with you. A pleasure to have you on the show. Hope we do it again soon.
Thanks so much.
That was Liz Miller, founder and president of Summit Place Financial Advisors. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Here, and Liz had a number of interesting things to say there. I was thinking about this, there's a lot of it there in terms of where we are in the economic cycle, and not so much what we're going to get from the Fed next week, but what we're going to get the Fed in mid-2026. And it always feels weird to start talking about 2026, but you realize we're coming near the end of October. We're going to get there sooner rather than later. Yeah. And that's really where we start to have to putting our focus on. What does next year look like?
Yeah, absolutely, Greg. I mean, I think that's all eyes are turned towards that. I mean, she's obviously alluded to the fact that they're looking at those rate cuts in a meaningful way and looking at opportunities in sectors that might be big beneficiaries of that. She talked about the home builders, of course, which might, if they bring those rates down meaningfully into that 5% level, as she mentioned, that could start bringing demand back, where it's kind of almost hit the lowest peak point. I know a couple of shows ago on Active Trader, we covered this, and we said when we were covering a home builder there, that it's at the lowest point in terms of what new housing starts have been. So that could be the next sort of sail in the wind as we head into fiscal 26 with a lot of these companies.
Another great conversation on TD Active Trader Live. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. Just open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace, start trading for real. All right, now for a more technical take on what's happening in the markets here, and what are you focusing on?
All right, we talked a lot about gold so far, Greg. It seems to have course corrected, of course, this week, but so does its digital version, or what's commonly considered as digital version, and that, of course, is Bitcoin. So that's where my attention is going to turn towards for today first. Now, the reason I'm looking at Bitcoin, of course, this is a risk-on asset when you think of it through and through. And some of them have been, this whole space, the risk assets have remained broadly under pressure ahead of the first major U.S. macro data point that's going to come out since the shutdown, and that's the CPI release that's coming out tomorrow, of course. This is the only point of data that's going to inform the Fed for future interest rate adjustments with the shutdown that we have so far. Also with Bitcoin, there's 150 public companies that are allocating portions of their treasuries now to Bitcoin as a store of value. So this really does reflect a growing trend in institutional adoption. So when we look at the charts before, there's two things I just wanted to point out before we go into that point. Is you've also got the weakening of the dollar. So any weakening of the dollar is going to support a buy the dip mentality amongst the BTC or Bitcoin investors. Here's what the charts have been showing us for so far though, Greg. What I've got, I wanted to turn our attention first to this monthly rising wedge. So I did a zoom out view and we wanted to look at the pricing there, and we've got this big wedge that's formed out. We did have price just step out of it in midsummer there. It's peeled back into within this wedge. Now, typically really wedges are seen as a bullish or a bearish reversal signal. So we could see that trickle down. Really the threat is trickling down to the lower end of this wedge and breaking through into this key demand zone and the $92,000 level. But what I wanted to show just now is I'm going to zoom in just a tad bit over here and focus on this on the key levels that we have. So right now we see it just rejecting off this 110. So 110 is the line in the sand. That's your key. What was a key support here in late August. It tested it, bounced off of it, but now we had a clean breakthrough. We just had a break just 2 days ago. We saw huge pressure touching up at the 114, but institutional dumping then took place and we broke back below the 110 level. We're still sort of flirting with that 110 level, but what we want to see is at least a break above it, a retest of it to resume this trend that we have started here. So this is what I'll be looking out of. I do take some heart knowing that we got this inverted hammer candlestick pattern, which is a bullish reversal pattern off the bottom low, so that could start breaking us into this new support and into the this sort of upper trend line that we've got formed here.
All right, interesting chart work there on Bitcoin. We have also promised the audience right from the top of the show a bit of chart work on Microsoft. What do you got for us?
Yeah, let's talk about Microsoft here. So, of course, Greg, as you mentioned earlier, Microsoft has its earnings along with a lot of the major tech companies that are going to be next week. They'll be reporting on October 29th after the market close. EPS consensus is 366. That'll mark about a 12% year-over-year growth and 75.3 billion on the top line, which will be about a 14% growth. Now, the big story with Microsoft since the last quarter, of course, they've been doing a lot of spending, as we know. The capex they've maybe made out of the media news around with NVIDIA and AMD sort of taking over, but they signed a 17.4 billion deal in sort of mid-September with Nebius for dedicated GPU capacity from its New Jersey data center that'll kick in later this year, or towards the end of this year, I should say, and into 2031. And this deal represents one of the largest AI infrastructure agreements ever signed. They also came out with the first supercomputer for OpenAI dubbed GB300 in partnership with NVIDIA. Now, this integration is not new for Microsoft because they're already a owner or they've built up an equity stake with OpenAI from this get-go. But this also ensures that it does get priority access for the most advanced AI models for its own ecosystem that will really give it a competitive edge there. And the last thing I wanted to point out is they're actually looking at moving supply chains away from China deliberately and taking product manufacturing out in 2026. This will be mainly for their hardware, so the Surface tablet and the Surface laptops and some of those other products as well. So that'll be something to look out for this earnings. The way the price is shaped up, so let's pull up the charts over here. What we've seen, of course, is this clear sort of trend that it formed over here. It looked like a little bit of a wedge pattern on the intermediate or short-term scale. We did have this big pop, which led to all-time highs, touching it close to about the 560 level. But this is a big inverted, bearish reversal on the weekly candlestick, if you look at it. So we did see a reversal and come down to where it's really finding support at the 500 level and the 515. So those are the core sort of key areas there. You can see the 21-day moving average, which I've got in yellow here, and then the 50 days clustered right below it here. This is really showing that level between that 510 to 515-ish. This is the key pricing here. Now, the expected move coming into this earnings is about $27. So we should, if that to the downside, that looks around that 495, maybe touching that 150-day moving average, which is sitting at that 496 level. And to the upside, we might break past this 535 level and test new highs. So these are the levels to look at and seeing it, but it's just been a lot of chop recently before the earnings, which will be the catalyst here to really drive price.
Right here, you've done all this wonderful work on the chart. Now you're going to walk us through a couple of ways we could trade Microsoft. Before you get started, though, just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Take it away, my friend.
All right. Let's start over here with the bullish play that one could do, Greg, if you are thinking that there could be some upside movement. I've also looked at the charts to see what could drive that moment. So I just wanted to show that what we've seen on the daily chart, we've seen this, what you call an inverted head and shoulders pattern, which could just mention it's a bullish push up. Now, it has to break this sort of neckline that's formed and really confirm before we see the new leg up. So one trade that you could look at doing, especially with earnings around the corner, is a butterfly call spread. So this trade, in fact, comprises of three separate option positions or legs, if you want to call it that. So what we're looking at is looking to buy sort of what's at the money right now, the 520 call. This will be just for next week's expiry, the 31st of October. And then I'm looking to sell where I believe there could be a sort of a natural resistance point, even with the move that's anticipated to come out here. Last year, you know, it had an outsized move, but on the second day after earnings, it peeled back, broke about that, and rose about like $15 overall. So 535 is where we're looking at the resistance point, and then just buying a further out 550 for an even spread across the board over here. It is $15 wide. Right now, just the premium on this trade, at least at the start of it this morning, was around $2.40. So really, this is why I want to do this. The reason why we want to sell is because we want to reduce the cost, knowing that you know, volatility is expanding going into earnings, and options do tend to get a little bit more expensive. So by doing the sell, it does reduce my cost, but at the same time, it also helps me reduce my risk as well, Greg.
All right, I love you put that little legend box in there all the time now about max profit and mass loss. Or max loss, I should say.
Exactly, and that's just the move. We needed to go up to 535. We make the difference between the spread, which is $15 minus my cost at 240. So that means 1260 is what I stand to gain on a single contract. If it goes beyond the 535, we're not losing money yet, but if it goes past the 550, then we will be out what we spent, and this is the 240. And of course, if the stock doesn't even make it to the 520 and actually peels back to the downside, then that's what we stand to lose, is just the debit or that we put in this trade there.
Bullish butterfly spread. What else you got for us?
All right, so that means we're going to flip the switch and we're going to go over to the bearish side of a trade here. Now, again, in this case, we're now looking to not really speculate on the trade, but we're looking to generate some income based on where we think the move might come to a standstill. So again, here, what I've noticed is the recent high, the all-time high it got rejected off this single day. I mean, it made the high, got rejected, and pulled back into this 525, 535 level. So we're looking to sell premium into earnings, and one way of doing that is through a credit call spread trade, or also known as a bear call spread. So we're looking to target the 550 strike over here. This is going to be for further out expiry here. So the 21st of November is what we're looking for. And then just selling 15 points out of that for a 565. I want the risk and reward to be more aligned. So in this case, this is going to generate a premium of $3.70. Now, whenever you're a seller of options, Greg, whatever you collect in your premium is essentially what your max profit tends to be. And the whole idea with doing any sort of selling strategies when it comes to options is we don't want the stock to get to the short strike price. So in other words, I want Microsoft it could make a move up, but I just don't want it to get to the 550 level there. So that's the one to keep an eye out. And I know we're going to talk about the risk. So the risk is, of course, if it does blow past the 550, we get into the 565, we're going to be in a little bit of a pickle, because it's going to mean that this spread's fully in the money at $15. And our loss stands at $1,130 in this case, and that's just the $15 minus what we're hoping to spend, which is $3.70, which is what makes that difference up over here. And so our break even's at $553.70, and that's when we start losing money if it goes beyond that price there.
All right, some interesting strategies there on possible ways to play Microsoft. We're coming to the end of another show here, and we're going to be back, of course, on Tuesday. What do we got up for the debate on Tuesday?
We are debating the pharma companies. I mean, we did Johnson & Johnson not too long ago, but we're doing another pure play, and it's Eli Lilly that we're going to put to the test, Greg. You know, the healthcare space is heating up, especially, you know, with AI being integrated into, and we want to see what, if any, Lilly has any opportunities there as well. So we'll be taking a little bit of a microscope on them.
Yeah, well, we'll save it as a surprise for the audience who's going to be the bull and who's the bear. But I picture you guys like meeting in a field of honor somewhere in southwestern Ontario.
It is.
Either you're doing some hand stuff or playing out of a hat or flipping a coin. But that's how I imagine how it goes down.
Yeah, it pretty much goes down that way. Maybe we'll enamor the audience with it on our show one day. So stay tuned for that.
Ooh, special field shoot. All right, my friend. As always, investors at home should perform their own due diligence before engaging in trading. Thanks for watching.